welcome back to the channel, your number one source for income-oriented investing. Time to go over the entire income-oriented covered call landscape on the American stock market. So this is definitely for my American watchers and of course Canadians who invest on the US stock market in their RRSPs, especially if you're an income investor. You got to put that in your RRSP. So let's start with how the market has done in the past week. It's volatility is back in the market. So for the record, I am filming this on March the 12th, which is a pretty positive day, but I'm looking at the 1 month chart here, and you see that the S&P 500, the best gauge in my opinion of the overall US stock market, is down 7%. The NASDAQ 100 even further, a little bit more. NASDAQ, as we know, is much heavier in the tech stocks, and it's really the tech stocks that have had some volatility lately, down 9%. And then you have the Russell 2000 down 10%. And even Bitcoin took a hit, went from its ultimate high of 105,000, and right now it's at 82. It actually went under 80,000 for a little bit there for a day or two, but now it's at 82. So that's it for the landscape. Remember, everyone, to stay cool, calm, and collected. Remember that we're income investors. And although this might seem very scary, especially if you're a newer investor, if you actually widen the chart to 1 year or 5 years or 2 years or 3 years, you'll see that it's really, really not scary at all. And this is really the privilege of being a retail investor. Retail investors, we don't have to worry about the next quarter like hedge funds have to or corporations have to, right? Investment bankers, they're always worried about the next quarter and then the next quarter. We're only interested in the long term. Remember that in the long term, the market always goes up over time. So let's take this opportunity, keep buying as much as you can, keep reinvesting as much as you can. And in the long term, as you could see here in the last 5 years, it will always work out, right? Even if you look at the NASDAQ, we did experience some volatility in 2022. So, in case you're a new investor, you might be thinking, if you bought in February or a few months ago at the top of the market at 22,000, you might be very disappointed now because you're like, I bought at the top. But people like that say this exact same thing in 2022 when they bought at 16,000. Then it went down to 10, 11,000. But guess what? Those people who have kept investing, held firm, are up anyway now. So basically what I'm trying to say is there's always going to be a fresh record, guys. The market can't just go up and up and up every single day. It has to pull back, it has to correct, and this is a good buying opportunity. So let's check out the income landscape now. Before we continue, I'd like to take a moment to thank the sponsor of this video and the monthly series, Tidal Financial Group, and we know that YieldMax ETFs is under their umbrella. And just to let you know that they recently came out with their own 0 DTE covered call ETF. So you have SDTY, which focuses on the S&P 500 index, QDTY on the NASDAQ 100 index, and RDTY, yeah, you guessed it, on the Russell 2000 index. So all three of these ETFs write or do covered calls daily. That's why they're called 0 DTE covered call strategy, and they seek to distribute weekly income. So again, thank you to Tidal Financial for being a good friend of the channel. So let's start with the S&P 500 income-oriented covered call ETFs, which I've separated in three groups. You have the not exactly S&P 500s, then we have the classic S&P 500 covered call ETFs, and then the daily S&P 500 covered call ETF. So we're going to start with the ones that are not exactly, they're based on the S&P 500, they're not exactly the S&P 500. So of course we have JEPI here, we have Bali, and we have YieldMax. I decided to put YieldMax into this mix because YieldMax is, the more diversified it becomes. It's kind of like a concentrated S&P 500. I guess you could even say maybe a concentrated NASDAQ 100. But there's also some S&P 500 stocks in there, so I decided to lump it in with these three. So make that 4, by the way. I forgot about our SPA, which is the S&P 500 equal weight. So this is the S&P, but it's equal weight, so it's not market cap weighted. So in terms of JEPI's dividend, the last one here for March, pretty steady, pretty, you're always going to expect about 7 to 9% yield with JEPI here. Bali doing really well. Monthly distributions do vary greatly. The latest one, 20 cents, pretty much in line with the last couple of ones. So in terms of yield, you're looking at about kind of similar to JEPI, maybe a little bit higher. You're looking at 7 to 9 as far as I could see. RSPA, the equal weight one, a little bit, just a tad bit higher. You see that here, about 9, high 9s, 10. Of course, you have YieldMax, which is a weekly pair, very, very, very high distributions. But let's look at the total returns between the three. So all of them except RSPA have been out for a year, and Bali is clearly the winner here. So Bali continues to shine. YieldMax definitely in the short term, obviously under a lot more pressure because it has a lot more exposure to those tech stocks, to those NASDAQ stocks. JEPI though, actually in the last 3 months has outperformed Bali. So JEPI is what I would consider the most defensive one out of the four, and then of course you have the equal weight one, which is doing okay, I guess. It's still year to date, 3 month. It's still, Bali is still outperforming RSPA, but I'll still continue to cover it because it is a kind of an S&P 500 style ETF. So that's it for these four. Moving on to what I would like to call the classic or officially classic S&P 500. So this is actually the S&P 500 with classic cover call strategy, or basically non-zero DTE or non-daily. So you have GPIX, which is what I always use as my benchmark. This is from Goldman Sachs. It's basically very similar to JEPI, except it actually is the S&P 500. It's not stock picking like JEPI does. And the distributions have been quite steady, very, very nice and steady. You're looking at about 8.5% yield on this one. So if you really want just that basic classic option, GPIX is always good. You have SPY-I, which is also another classic one, a little bit more covered calls than GPIX, which means you're getting a much higher distribution rate. Instead of 8%, you're getting a very consistent 12% annually or 1% a year. And they've managed to really shine in terms of the distribution consistency. Very, very popular, obviously, with just under 3 billion in AUM. Then you have the BlackRock, the lowest fee one, the rinse and repeat IVVW that just does a 1 month call, 1% out of the money call. You see that right here in the index, right? 1% out of the money. So this one has very, very high yield, except the distribution could vary very, very, very greatly. If we look at the trailing, no, they don't have it here, but the distribution based on the last one, the yield based on the last distribution rather is 8.6, but it's been it shrunk a lot. It basically went from $1 to 55 cents to 32 cents. So I do expect the next one probably to go up because volatility is higher. So that's it for the three classic ones, I would say. If we look at the total return, I'm surprised. I thought IVVW, we would have the data for a year. When did this one come out? March 14th. Okay, so it's literally going to be a year in 2 days. So hopefully next month we'll actually have the 1 year data. But GPIX is leading the pack in terms of total return, which is not really surprising, But SPY-I really not far behind in terms of the 1 year. But don't forget, guys, I also put XYLD, by the way. I forgot to open the webpage. But XYLD is doing particularly well lately in the last 3 months because there's a lot of volatility, and XYLD pretty much writes the most aggressive covered calls. It's basically giving up all the upside. So obviously it's going to do really well. It's done really well in the last 3 months. But over the long term is really what counts. If you do XYLD versus any other one, you got to use this. Basically, this is what I was referring to, right? Yeah, if you actually do GPIX versus XYLD, you'll get much further out than 1 year, and you could see that GPIX is clearly outperforming XYLD. So yeah, you always got to make sure to use this tool as well. not just focus on the 1 year, right? You got to look at the since inception, or this tool automatically selects the right start date. It selects the start date of the fund that was created later. So moving on to the daily ones, the 0 DTE daily covered call S&P 500. You got WDTE, which pays weekly and is definitely the highest yielding one. You have SPY-T, which targets 20% a year. Of course, you have XDTE from Brownhill, you have iSpy from ProShares, you have T-Spy also, and now you actually also have SDTY. So there's quite a bit of differences between them. So I'm not going to go into detail every single month, guys, but basically WDTE, this is really an income-oriented product, not a growth or total return product. This is just to maximize your income. This is a little bit more growth-oriented because of the distribution rate. They're just trying to pump out 20% a year. So it's good if you like daily options, if you like the S&P 500, if you like, does this one give weekly distributions? I'm drawing a blank here. Yeah, I believe it. No, it actually does not have weekly distributions. It has monthly distributions. So this is if you want monthly distributions, but very consistent 20% annually. You have XDT, which pays weekly, but they're going to be different, right? The distribution rates are going to be different every single month. The last one here is a little bit higher, much higher than the last week. You're looking at about 20% yield with this one, pretty similar with SPY-T. You have iSpy, which the good thing about this one is it's the lowest fee 0 DTE one. Of course, ProShares, they're much bigger, but the monthly distributions could vary tremendously as well. You're looking a little bit lower yield with this one. T-Spy, it is monthly paying, but everything else is really good. It's a very, very consistent 14.5% yield. It pays monthly. It does have 0 DTE options. And then you have SDTY, which is very, very similar to Roundhill. Make sure to check out the Q&A that's coming up with Jay, where we talk about the YieldMax 0 DTE or index. They have SDTY, QDTY, and RDTY. We talk about these ETFs in detail, so make sure to check that out. That's coming. But you're looking at a very similar yield and strategy to the Roundhill one. So there's a lot of S&P 500 option, guys. If we do the total return comparison with some of these, and I left out SDTY because it's been very, very, very early, and a lot of these have not even been out a year, guys. But I think by next month, we're going to get SPY-T and XDT 1 year performance, but it's actually really, really close between XDT, iSpy, and T-Spy. I think iSpy currently has the edge over everyone. So if you just do GPIX, which I like to consider my standard, versus XDTE, you see that XDTE still has a little edge. But if we do XDT versus T-Spy, T-Spy has the edge, I believe. Very, very, very slightly. But again, it's early to tell. This is only 6 months of data. And if you do XDT versus iSpy, which there's definitely a lot more data, you see that iSpy just took the lead recently, a very, very, very small lead. So they're in close competition. There is no right or wrong on which one you like. Obviously, you guys know I always say the S&P 500 should definitely be a foundational core position in your portfolio. But now there's like 15 different S&P 500 cover call ETFs. It's just a matter of figuring out what's more important for you. Is it the total return? Is it the consistent distributions? Do you really love the weekly payouts versus the monthly payouts? There's no right or wrong. And of course, you could always combine a few of them as well, right? So now moving on to the NASDAQ 100 covered call ETFs. We'll start with the ones I consider classic, the classic strategies. So you have QYLD, you have JEPQ. So QYLD is that rinse and repeat strategy. You have JEPQ, where the latest distribution is a little bit higher. I do expect them to probably go a little bit higher because volatility is higher. And typically when volatility is higher, the distribution should go up, just like what happened last year in that August-September timeframe. But you're looking at about 10-11% yield. Of course, you have GPIC, which I consider the benchmark. Right, the Goldman Sachs ones I always consider the benchmark, and I always like to compare everything to these ones to see what they're doing in terms of total return. So very similar to GPIX except it's the NASDAQ 100. So you're looking at 10% yield. QQQI as well, a great option, very consistent, just like SPY-I, very consistent 12. This is a very consistent 14. You have also Invesco, who is actually the creator of manager of QQQ, the QQQ index. They have their own one as well, which is, I would consider it classic and more close in terms of yield towards the GPIC. In terms of the total return, well, we do have a year for quite a bit of them here, and we could see that, hey, still NEOS has an advantage, very, very close with GPIC. So I do expect JEPQ, GPIC, and QQQI to be really very, very close. We'll see what happens over time, but they're obviously, and I do expect QYLD over time to always be in last place because, you know, they're giving up pretty much all the upside. So again, no right or wrong which one you like to choose. The NASDAQ is a really, really good index, guys. I think it also should be a foundational position next to the S&P 500 for any portfolio or income portfolio. Moving on to the NASDAQ daily one. So you have QQQY, which is, again, more income oriented, not total return oriented. Crank out as much income as possible. Pays weekly. QQQT, same deal as SPY-T. Looks like it looks to give a target 20% yield. This is monthly distributions. You have QDTE, which is obviously very, very popular. It's getting to that 1 billion here. Not yet, though. Weekly distributions, and the latest one is definitely higher than last week, but they're inconsistent distributions. You have IQQQ, also the one from ProShares, which is iSpy, but with the NASDAQ. Same management fee, though. And this one, again, it's monthly distributions, but they could vary greatly every single month. And you have QDTY, new competition in the zero DTE space, also weekly paying. They're obviously competing with QDTE, so I'm curious how they're going to do over time. And again, stay tuned for that Q&A with Jay, where I actually asked them point blank, what is the difference between the YieldMax ones and the Roundhill ones? So if you look at the total return, again, a lot of these, not even a year it's been out, so we don't have too much data here, but the ones that are leading, I believe, are the QDT and the IQQQ in terms of total return. Moving on to the Russell. So the Russell ones, we have a little bit less options, but you have the one from BlackRock, which is the lowest fee one. This does a rinse and repeat 2% out of the money call on the Russell, and with very varying monthly distributions. So this one could be this is a good one if you really want the low fee. You have the one from NEOS as well, which is similar yield to their QQQI. So, you know, very consistent distributions. I know many of you love consistent distributions. This is definitely one to consider. You have the one that's the highest yielding one, pumping out as much income as possible. And you have the zero DTE ones with RDTE, ITWO. So again, the zero DTE competitors, it's the same ones, right? You got Roundhill, you got ProShares, and now you have also RDTY, from YieldMax. I'm going to go crazy with all these. I hope nobody, I mean, Tap Alpha is probably going to come out also with a NASDAQ and a Russell, but this is just crazy, guys. There's so many options here. In terms of having the Russell in your portfolio, I prefer the S&P and NASDAQ 100 more, but if you want some small cap exposure, the Russell 2000 index. An index is always the simplest, easiest way to get it. You could always add a little bit of whichever one you prefer in your portfolio. If we do the total return comparison, again, most of them not out for a year here, so there's not much data we could check, but always remember to use that tool if you really want to check the real total returns. But you see here, and it makes sense, the Defiance one that's really specialized in income, right? This one here that over time will probably have the crappiest total return, but the highest yield because they're doing the most covered calls, is actually doing the best, I believe, in the last 3 months by far. Yeah, here it is. I mean, you could see the other ones are all down significantly higher, and this again makes complete sense because it's writing the most covered calls. One thing I noticed that in QQQY, it's actually not the case. You have QDTE that's beating it and QQQT that's beating in the last 3 months. So it's just strange how sometimes it doesn't work out how you think it's going to work out. So this doesn't make sense to me. I would have figured that QQQY is would do the best in the last little while. But if you look at year to date, you could see that QDTE is still outperforming it. I find that weird. But with the Russell one, it kind of, this is what makes the more sense to me. It's this one is actually doing the best one because it's giving up the most upside, and now it's a down flat market. But anyway, that just goes to show you that you just never know. You never know. Moving on to the more to other ones, alternative and really some tech and crypto focused ones as well. I'll cover these as well. You have GIAX. This is really the only one as far as I could see for your that has global exposure. A very nice consistent 24-25% yield. So this one is good in terms of distribution consistency. They've been trending a little bit down over the past couple of months, but nothing too crazy here. You have SFOL as well, which to me is kind of like an S&P 500 alternative. Yes, it does the VIX strategy, but it actually does have a lot of S&P 500 exposure now. You see that here. This is even SPUC. This is kind of like the S&P 500 with covered calls. So there's also some bonds in here, quite a bit of fixed income. So yeah, it's still good. My personal opinion, guys, you might as well just stick with an S&P 500 instead of SVOL. But that's just my opinion. A lot of people like it, and that's okay. That's fine. It's still a pretty good fund with pretty consistent distributions every single month. And I think lately they re-raised it. Yeah, it's at 27 cents now. So we'll have to see what happens next month. Now, there are a couple of niche technology and crypto ones. So for technology, you have FEPI, which is typically 25% yield, more like classic technology stocks. You have AIPI, which focuses a little bit more on AI type technology stocks, but there is some overlap with a 35% yield. You also have GPTY, which is AI and tech. So this is YieldMax's kind of competition to these ones as well. And I believe this is weekly income as well. So this could be a good ETF if you want technology AI stocks and you want weekly distributions. This is definitely a consideration. And you'll have the stocks that, some classic tech stocks like NVIDIA and Apple, Meta, Microsoft, Alphabet, AMD. So a lot of technology and even some more AI companies like Palantir and C3, Snowflake, I guess, et cetera, et cetera. So it could be a good option if you want to play the sector here and you're an income investor. In terms of crypto, so this is crypto related stocks. You have SEPI from Rex Shares. So kind of same style of Rex and same style as FEPI and AIPI, except it's more crypto stocks. And the latest distributions show a very high yield of 40% plus. And it's all crypto related companies, including Visa, MasterCard, NVIDIA. Of course, you have MicroStrategy, some chip makers, Marathon. I'm sure Riot's there as well. And YieldMax has the same thing, LFGY. This is for crypto. And it also pays weekly. This is a weekly payer as well. And it's going to have similar stocks, right? Stocks similar. But I definitely kind of like the mix here. There's a big chunk in MicroStrategy and Coinbase. They actually are basically just holding Bitcoin. They also have Marathon and Riot, the miners. So I'm kind of liking the stock selection better in this one than SEPI. But anyway, you could have both, or if ever you want crypto stocks with income, with covered calls, these are great options as well. When it comes to pure Bitcoin options, you have YBTC, which is weekly paying, a weekly payer. You have BTCI, and you have Maxi, which it's not really covered calls. It's just put spreads and call spreads and things like that with Bitcoin exposure. And if we look at the total return, Maxi has really been taking a hit lately. If we look at the 1 year, and if we actually compare it just to the Bitcoin ETF itself, you see that I believe BTCY is the leader. But you could see that obviously Bitcoin has been skyrocketed in the last year. When you're doing covered calls, you're giving it up income. I'm very surprised that Maxi is really starting to go behind now. So I used to own it. But again, it's up to you which one, if you do actually want Bitcoin exposure. So give a thumbs up, everyone. I would really, really appreciate it. I keep forgetting to ask in the middle of the video, but please hit that thumbs up. It really helps the channel, really helps the video. That's it for the overview. Again, guys, take advantage of the recent volatility. Everything is on sale now, especially the tech sector. So there's lots of tech-only options like I just showed you here with FEPI and AIPI and GPTY. But don't forget that the NASDAQ 100, guys, is very, very tech-heavy. And you have such an amazing lineup of NASDAQ 100 covered call ETFs for every type of investor, whether you're prioritizing total return, you're prioritizing income consistency, you're prioritizing distribution frequency. And you could combine a few as well. There's more than enough to go by. And again, remember, an investment in any one of these is an investment in the NASDAQ 100 index, which is very tech heavy, even more so than the S&P 500. But anyway, just keep buying, keep averaging down over time, because the market always, like I showed you at the beginning, guys, right? If you look at the last month or 6 months, it could be a little bit scary. But if you look at the 5 years, it's really not that scary. So again, stick to the plan, stay focused, keep buying over time, and you'll always do well.